Now, I had a pretty interesting email thread with a very famous YouTuber, or very famous to my standards. Credit card default now hitting 2008 levels. Market is absolutely on a sugar rush due to the AI movement and the fact that there is a possible bill on the table that's going to get passed to raise the debt ceiling roughly another 12%, going from $31 trillion of debt to roughly $35 trillion of debt over the next 2 years, making the debt to GDP pretty lopsided here, and that's where it gets dangerous. This is a debt-based system, so the debt growing is not necessarily the problem. The speed at which it grows versus the GDP is where it becomes pretty interesting. This may be one of my last videos, so I'm probably going to make it a little bit long, but hopefully you guys enjoy.
At this point left to offer. And I would just point out in terms of the ongoing discussion of lack of breadth, there are weak ways to measure that, and this is very important. If you talk about new highs or new lows, that's arbitrary. For instance, Netflix could be making a new 52-week high, but it's still 50% off its all-time high, right? Or, for instance, a number of stocks above or below a moving average. If a moving average is dead flat, if you have a 2% up day, a lot of stocks get above that moving average and change the statistics, right? Advanced decline. So the real way to consider is the move since the October low, broad or not. It's simply this. If there are 3,000 stocks in the Russell 3000, there are a few less because of basically buyouts and so forth, but all constituents since the low, global low in equities, from the DAX, the CAC 40 to every index, how many of those constituents are actually up if that's the low? Here's the answer. 50% of all stocks in the index are actually down from their October 13th.
So Carter Worth, who I actually follow a little bit here, is always level-headed when it comes to the market. I think a lot of these panelists get very emotional because they have money involved. Carter is very level-headed, really looks at the charts, and I tend to think that doing a combination of looking at a chart direction and the fundamentals of companies is the best way to go. And what Carter points out here is the fact that this breadth has really been lopsided. 6 to 10 names has carried this whole market, which means that there's thousands of stocks trading pretty close to the October lows. And this doesn't seem to be what the market is telling us. So we have to dive a little bit deeper here. And if you haven't owned one of these 6 to 10 names, you've probably underperformed the market significantly. Now let's talk about the macro backdrop here. As we did do some numbers months ago and said that the consumer was going to run out of money roughly between October to November is where we figured out. And how we did this was we looked at consumer debt climbing, we looked at interest rates rising, and we said defaults are going to be on the table. And now you have to factor in that student loans have to be paid, which the average payment is just over $390. And that's going to leave a lot less money for discretionary spending. And we're starting to see a lot of disconnects in the market. And so if we factor in that roughly $1 trillion of default is taking place on credit cards, we have $1.5 trillion of refinancing that needs to take place in the commercial real estate aspect. We're going to see a massive issuance of debt once the ceiling gets passed of over $1 trillion. And this is going to suck up a tremendous amount of liquidity from the market, making the back half of this year very interesting. Now, how recessions work is we go into a recession, we don't even know we're in a recession, and then we get confirmation of that recession, which I've lined up on the chart numerous times to come around the February mark of next year, which means that basically by the end of this year, we're probably going to be seeing some serious turmoil, some serious layoffs, and then eventually we get the confirmed recession and a market bottom. I do believe, however, that even though the market is rallying right now, we still are in a high-risk period until we get out of June. Now, here is an interesting statistic that I just stumbled on. High net worth individuals, people that have $1 million or more to invest, roughly 23 to 25% of their money is in the market, while the rest of it is earning a high yield. They're taking advantage of the interest rates, and they're very uncertain of the economy going over the next 8 to 10 months. But yet this rally has been pretty serious, especially with the AI movement, which is telling me it's a lot of algo, it's a lot of FOMO trading with retail investors that are unsophisticated, as the smart money is still sitting on the sidelines earning a high yield and has roughly 25% in the market. And I want people to understand that we are in a contraction period here. Earnings have revised, and yes, they are beating a revision. but they are still coming down, but prices are going up, which is making this market very expensive. Now, I had a pretty interesting email thread with a very famous YouTuber, or very famous to my standards, and somebody that I really respect as far as macroeconomics go and charting. And my thesis is that the initial deal getting done is going to be a knee-jerk reaction to the positive, roughly getting to 4,250, maybe 4,300 as we get a blow-off top, and we fill some gaps on the chart. But the liquidity drain that's going to take place, a short spike in yields, which is going to reprice stocks, I think is going to happen here pretty soon. The time frame, I think over the next 6 to 7 months, after we get this blow-off top deal done, as debt gets issued, we will see a liquidity drain, and we will see a repricing in stocks that take place very fast. I don't think this will be the true bottom, as I do think the true bottom is going to come next year. As I stated before, I still think the job market's fairly strong. Consumers still have a little bit of money left, but we can see defaults are now on the table. These defaults are going to take some time to really get through the system, and we won't really feel the pain until closer to the end of this year when we get past the summertime. And that's why I still think recession is on the table for the beginning of 2024. Now, if you want to go back through my videos and check out the charting that I've done, feel free. As always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.